What's all this business about Goldbach levels?
In this video, I'm going to show you how to use Goldbach to determine your higher time frame bias, and this helps especially if you're a scalper. Now, once you use Goldbach for the higher time frame direction of price action, you can also take swing trades. So I'm going to do the complete rundown for you now. If you are unfamiliar with Goldbach, then I have an introduction to Goldbach video on my channel. And if you need an introduction to the Goldbach indicator, you can find that also. Now, looking at the higher time frames. As you probably are aware by now, if you've watched my channel, I like the 243 power of 3 when it comes to the higher time frame narrative for Euro USD and GBP USD. So opening up the indicator, we set the power of 3 number to 243. There we go. Now, of course, we need a higher time frame view of price action. So if we go to the 1 hour and start building a narrative. All right, so let's have a look at this price action. This is the range. So if you are rusty with Goldbach, what the Goldbach indicator shows you is the mathematical levels that the algorithm uses in order to price. So the dealing ranges that are created are based off of these power of 3 Goldbach levels. So based off of the 243 on the 1 hour time frame, the low of the dealing range is here, the high is here, and the equilibrium is here. Now, what did we do? Okay. We started creating this liquidity here, and we created all this trend line liquidity. So let's draw the trend line liquidity out. So all this trend line liquidity should have given you an indication that the algorithm is up to something. Now, the second thing you want to notice is price. When we were here, price was in a premium. Okay, this is the premium, this is the discount, this is the equilibrium. This is the great thing about the Goldbach levels and the Goldbach dealing ranges. It tells you that you should be shorting in a premium and buying in a discount. So what was price action doing? We created all this liquidity in the premium of the range just above equilibrium. Okay, this was your first heads up that the algorithm was about to play out. Okay, so we have this trend line liquidity, and then what did we do? We created a high, we rated the high, and then at the final rate of the high, at the right time, we had a power of 3 stop run. Okay, so all this liquidity, so we took it once, we took it twice, we took it 3 times. This liquidity was grabbed into the extension of the dealing range. The extension of the dealing range is the extreme of the dealing range. Okay, that is where the algorithm likes to take out all the stops. All right, so we have this rate of liquidity. Okay, once we've had this rate of liquidity, your eye should immediately drop down to equilibrium, knowing we have liquidity there, because ideally you want to find a short within the premium and you want to take it off at your first opportunity in a discount. So selling in a premium, buying back in a discount. Now, if you are familiar with my work, you will know that algorithm 2 is the easiest algorithm to spot when it comes to Goldbach. So what does algorithm 2 tell you? Okay, essentially, you're going from the high to ideally the breaker, but I'm flexible with this. So I say to a point, to a swing low, we retreat or retrace back into the fair value gap. And then the extreme move of an algorithm 2 should finish at the opposing order block. Okay, so what do we have? Trendline liquidity is a power of 3 stop run into the extension. And we can measure this out. So this is the high on the dealing range. This is the extension. So 31 pips, which is roughly 27. Okay, so 27 pip stop run into the high. There's your order block. Okay, there's your order block. And there's your fair value gap. So what did we do? We went into the high, power of 3 stop run into the extension, create a fair value gap in the fair value gap level. At that point, everything is aligned and you would take your short. Now it's up to you where you want to put your stop loss. Maybe you want to put it at the swing high. Okay, and where would you take off your partials? Your first partial would be taken off at equilibrium. You have all this trend line liquidity at equilibrium. So that's your first point in a discount. This would have given you a 3-hour trade. Now, for your runner, okay, you have the opposing breaker, where liquidity has obviously been created at the Goldbach level. But you may want to take it out at the opposing order block. Okay, because this is where algorithm 2 ends. High into retraces into the fair value gap, and then it should terminate at the opposing order block. This is where you get the bullish order block, and you may have that upwards movement again. Now, some extra confluence here. We had a nice market structure break right here. Okay, the market structure break gives you a really good heads up that we are looking for lower prices. So after we have the market structure break, you're looking for displacement. There's a displacement. Now, why didn't it go into this fair value gap? Okay, people will say because this is a balanced price range. Okay, not quite. The true fair value gap is created within the fair value gap GB level. And you can see how sensitive it was to this fair value gap. Okay, market structure break, enter on the fair value gap, stop above the swing high, an easy 3-hour trade. And then for the rest, if you leave a runner, you could take it off at 6-hour. Okay, the question you're going to ask is, how about this fair value gap here? Okay, why wasn't this applicable? Because time and price have to align. It's not just about where the Goldbach levels are. Okay, once time aligns with price, that's when you take the trade. As always, if you have any questions around Goldbach, feel free to leave a comment below. If you would like to join my exclusive mentorship, where I teach my time and price golden bullet strategy, which I use for Forex, crypto, gold, silver, oil, index futures, is a link in the description below.
What's all this business about Goldbach levels?